I think this year and the next couple of years is going to be the year of operational efficiencies, thorough asset management, finding those hidden pennies in the couch, especially if you have floating rate deals, etc. You just have to operate more efficiently.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. We've got a great guest today. I spent a couple days in Cabo San Lucas at a mastermind recently, and I know she's going to bring a ton of value to the show. Sandhya Seshadri. Close enough?
Thank you so much. Yeah, that's pretty good. Sandhya Seshadri. Jack, thank you so very much for having me on your show. I'm super excited for our conversation.
Yeah, it's great to have you on here, and we got to spend a fair amount of time in Cabo, and I know you're going to bring a lot of value to our listeners. Why don't we start with just telling your story of how you got into real estate investing and what you were doing before and how you made that transition.
So like most Asian geeks, I have a background in engineering, and I was in corporate America, and I also got an MBA part-time because I realized that the business folks were making all the decisions, and I got into several investor clubs and was successful in the stock market, and I was looking for a way to lower my taxes. Wanted to get into real estate, but stayed away from single family, fix and flips, because I didn't have a handy person background. Wanted to avoid the 4 T's, as we call it: tenants, toilets, trash, and termites. So I attended a weekend event, learned about large-scale multifamily, got into syndications, first passively, and then on the general partnership side. So right now I'm in Dallas, focused on the operations side of 5 different assets at this time. I've had 3 full cycles. It's been great.
That's great. I got one extra T for you. Tourists, for those Airbnb operators. You could add the tourists to it. I don't want to deal with a tourist complaining about some issue on their vacation. So that's great. So you were able to quickly identify that single family houses are kind of difficult to scale. And I just know a lot of people, including me, years ago that, ended up creating myself a job just because of some of the challenges with single family. How did you, let's go a little deeper on that. How did you, get started? Did you go to a seminar? Did you have another operator that you just knew personally? Like how did you go from 0 to 1 and as far as getting involved?
So I attended a weekend event. I signed up for a mentorship program. I found other operators in that group, and I invested first passively and then found the partnership to do an active deal. The way I was useful was I've lived in Dallas for 33 years, and those partners were out of state and looking to do a deal in Dallas. So I was able to help them as the person with the local knowledge, boots on the ground. And we did this deal in 2019, but COVID hit in 2020 and they couldn't travel as much. So I learned a lot of the asset management side. I was the one always meeting contractors, etc. in person. They were definitely the brains, but that helped as far as getting my confidence up and knowing the full, soup to nuts of what it takes to run a deal and actually complete a full cycle on it. And when the first deal was very successful, it was easy to get the word out. And it was also the time of cap rate compression, so things definitely helped. It helped too.
So Dallas is one of the best markets in the country, in my opinion. But if you could tell us a little bit about that ride, obviously maybe you don't know it to the basis point, but like what was the cap rate on that deal when you entered it, and what happened during COVID, and what did it compress to when rates dropped? Just kind of maybe walk us through a full cycle if you could, with at least as close to the numbers as you can get.
It was an 86-door deal. It was about just under $7 million. We were able to get a nice Freddie small balance loan for it. We raised about $2.4 million with my partners doing the bulk of that. Me as a newbie, just sort of piggybacking off of their experience. They had done medium-sized multifamily in other states. And as far as the in-place cap rate, I think it was like in the low 5s range when we bought it. And then when we sold it, it was in the 4s. So it was way better. We bought it in August 2019 and sold it in November 2021. The business plan worked great. We did not have any disasters. We just did mainly the interiors. And then we added one extra unit by moving the leasing office from a unit to like the second half of like the laundry center. So we created an office there. And so we added a unit. That was a big value add. It was an all bills paid property. So we lowered the bills by doing water conservation as well as LED upgrades. And then the rest of it all was just interiors. That market was a very special pocket. It's called Cleburne, which is about 30 miles from Fort Worth. And people who lived in Cleburne wanted to stay there. They didn't want to drive an extra 45 minutes an hour either way. And it really helped. The market was booming. The city was putting a lot of money. There was a new high school being built at that time. So those things really helped. And we were able to 3.18x our investors' money. So more than triple their money. So 100K invested in 2019 with us would have given you more than 300K in November 2021. So that was a big home run for us, and half of it I would definitely attribute to just the cap rate compression. And that helped us tremendously with getting repeat investors back from that deal.
Yeah. You mentioned that leasing office thing, and then the power of value add when you're buying at any of these cap rates is pretty incredible. So what was the? Let's just do some back of the envelope math here. So, what was the rent on the new unit that was brought online by moving leasing office?
It was actually a townhome on one side and just basic apartments on the other. They had the leasing office in this townhome. So it was whole nice, $1,200 extra rent that we just got that was zero. So it was a direct impact to the NOI. So if you think about it as, a little like 14.4K and you put it on a 5 cap, you're at like 280K plus easily.
Yeah,
right?
so 288,000 in value unlocked just by, spending maybe $1,000 to customize the laundry room, add a desk or something, maybe nothing, maybe just sweat equity.
Actually, we spent about 7-8K to redo the laundry room because one half of the laundry center had all the machines. So we had to build a wall. Luckily, it already had the plumbing for a bathroom. And so that became the new leasing office. And then we had to put some signage to redirect people and then redo this unit from a leasing office to become an actual unit to rent. So it did cost some capex and some timeline, but it was negligible when you think of the NOI impact from adding an extra unit.
Yeah, 10K to make 288K or create 288 in value is pretty incredible. And what was, as far as the apartments themselves, was there a fair amount of rent increases through renovation, or was it just...
Yes. Huge rent increases, somewhere in the range of $200 to $300 per door. Times, you're talking 86 doors, it adds up really fast. So you're talking 18K from that. And then, of course, on a, 5 cap, you're at over 360K. So that was fantastic.
Yeah, it's really incredible. And, I have a fair amount of investors that are worried about the economy or that, how much further can rents go. And I try to remind, and the reason I brought that up is I try to remind investors that the real goal here is to create the value. If you have a heavy value add and you can create value, it really doesn't matter what happens with interest rates. If you're generating hundreds of thousands of dollars of value add just by smart operations, you should be able to make money in any market cycle.
Yeah, and we had a fixed rate loan, so we knew what our mortgage payment was going to be. So if the deal was able to cash flow by itself, then as long as you're cash flowing, investors are happy as well. So you can time the sale to when you think the market is a little bit better. Like today may not be the greatest time to sell. We're in mid-June in 2023, but if you can wait it out till 2025 or maybe 2026, maybe that's a better time to sell. So if your deal is cash flowing, investors are fine with that.
And so what are you seeing in today's market with these higher interest rates? When you're looking at a new acquisition right now, like what are you seeing in the market? What's important?
So definitely the debt structure is extremely important. So your lender is going to determine just how much they want to loan to you. And some of the factors are, the age of the property, the potential in the property that's been proven already by the, seller showing you that, I can actually get this rent bump by doing this renovation to this many units, etc. And your leverage is definitely less. So you've got to work with a lender who really knows your value add and your secret sauce, if you will, so they can position you best with a right type of lender. We are, of course, going for fixed rate loans in 2022. Also, we did 2 deals, both with fixed rate loans, and we love Freddie Mac because they allow you to lock in that rate early on. So that's something we look for is how does it size if I want to do a Freddie, big Freddie or a Freddie SBL loan, depending on the size of the deal. That's very important to us. And also, can we keep cash flowing if we cannot time the sale, right? There's no more cap rate compression happening. So you always want to underwrite it for a higher exit cap than your purchase cap, for sure. So in other words, you're planning for a tougher market in 3, 4, 5 years when you plan to sell this deal. And then we generally have reluctant investors when it comes to floating rate loans. They've been sort of slightly burned, if you will. So we are not doing that. I know some really good operators are still doing that. But the most important thing to remember then is to underwrite for the maximum of the rate cap that you have in place. And you definitely want to have a rate cap. But we're looking for deals that size well in excellent locations. We don't compromise on location. That's why I'm the local expert, having lived here over 3 decades. So as you give me an address, I know right away which property I want or don't want. I don't even have to spend much time underwriting and analyzing them because based on location, I'm going to veto like 90% of the deals that come through. So that makes it very quick for me. And then if I love a deal and somebody sends it to me today, like tonight, I'll be driving that property, in the evening and nighttime because I want to see how it feels, how safe I feel when I go there. So the whole crime and good location is very important. We want to welcome that single mom with 2 kids to come and stay at our property. So things you cannot change about a location, right? The crime stats, the neighborhood area, even if your property is safe and has patrol, etc., you can't really change what's happening within a 3-mile radius by yourself. So you want to pick the good suburbs, the safer locations. We love places like Irving, Garland, Carrollton, which are some of the popular suburbs of Dallas where we have properties.
That's great. And those are still, are you still in the Class B or Class C area, or have you ventured into any of the deals, what you might call a Class A?
I'm not going to Class A because right now in Dallas, especially, Class A is very expensive and the cash flow is much lower on a Class A typically because there's not as much of a value add unless you're in the lease-up stage of a new build. And sometimes you have to really closely watch those prices because the cost of new construction of a unit might be actually the same or less than a Class A that's about 10 years old. So you really got to watch that prices. I haven't found Class A pricing to be competitive just yet, so I've not ventured into that at all.
Yeah, we're on the same page there. I really think that Class B or maybe a C plus in a B area is the sweet spot. It's you're able to buy below replacement cost, and in a tougher economy, people may downsize from a high end Class A to the nicest Class B. And if you have freshly renovated value added Class B, I think it should be recession resistant.
Yep, agreed.
So I know you were a speaker at MFICon last week, and you mentioned some of the challenges or horror stories. So this business is great; you can be very successful, but it's not always it's not always butterflies and bubblegum. So why don't you tell us some of the more interesting or challenging things that have happened to you in the recent years?
So we had just acquired this property December 2020, and a month into it, I was meeting my interior designer, and I was in the property manager's office. My partner was also there, and we were about to step out of that office with the map in hand to go low box some vacant units to determine what upgrades we wanted to do, etc. And we heard the series of fire that was basically, a gunshot, and we were shocked to hear that sound, and we were like, this couldn't be. And sure enough, when we looked outside, we could see people scattering. It was a drive-by. Neither the shooter nor the intended victim lived at our property. So they just happened to be driving and, I guess, running into our property for safety, and this is what happened. And I couldn't believe it. I was 30 seconds away from basically being shot, so that was quite shocking. But, you recover from it, and you could either, live in fear, saying this is what's going to happen at these properties, or you could say, hey, there was a reason I was spared. There was a reason that was 30 seconds apart. Could have been me, right? So I have a purpose now. So I got to keep pushing. And the thing is, people assume as soon as you talk about these things that it's probably in a really bad high crime area. And the fact is, in 360 degrees around that property, it's all single family homes. And we were 3 doors from an elementary school and across from a church. So it checked all the boxes for a good location. It's just unfortunate it happened that way, but luckily nobody actually died. All the shots went into the stairs and the railings, and we could see the bullets on the ground, etc. So, it's a blessing.
Yeah, wow, that's scary. I mean, those things can happen. I mean, I live in a very nice part of Puerto Rico, a block from the ocean, and there was a shooting a few years ago, pretty high profile, but I think it was drug related, and obviously some of those guys want to hang out in the nice neighborhoods, sometimes they go to the nice neighborhoods to hang out, have dinner, and it just so happens somebody followed them there, and it's 2 blocks from where my house is, so it can happen. Can happen anywhere. Regardless of how good your diligence is. So I'm glad you were. I'm glad you were safe and sound. And sure it was an adrenaline rush.
Yeah. Thank you.
So in today's market with higher interest rates, you mentioned fixed rate debt. What do you see? And none of us have a crystal ball, but what are you planning for over the next 20? If you're going to buy something next month, are you modeling in interest rates declining? Are you leaving them steady? And how does it impact your decision to underwrite?
Definitely planning for interest rates to be steady. We're trying to buy deals that qualify for agency fixed rate debt. But we also plan for a step-down prepay, because the only bad thing about these agency loans is that the prepayment penalty can be pretty high for yield maintenance, and most people who underwrite deals don't factor that in. So if you want to sell it, let's say in 4 years, you have to know what your prepayment might be. Yeah, you could hope that interest rates go down, etc., but if interest rates stay where they are, I mean, you can't really bet on, those are all speculative assumptions. So it's better for me to know. So the 2 deals we did last year that were Freddie Mac fixed rate, we got step-down prepay. So I know exactly what my prepay is going to be if I exit the deal in year 3 versus year 5.
Yeah, so I don't even know this exactly, but what's, and for maybe the newer investors who aren't sure, I mean, there's yield maintenance where you essentially have to pay the entire interest rate, and there's or like kind of what maybe some people have seen on smaller residential where it's like a 5% the first year, 4% the second year. How does that get negotiated, and how do you choose between kind of a full yield maintenance deal, which I think can be really punitive if you have a good opportunity to sell, versus one where it just drops every year to a point where if it's 1%, it may not be that big of an issue if you have a good deal to sell.
I think that's what made a lot of these floating rate deals very attractive. When you have bridge or Freddie floater, for an example, the exit fee is very low and you know exactly what it is. So to make that decision, we went with step-down prepay because we wanted to know exactly what that number was going to look like for each year. So it is like a step-down, like a 5, 4, 3, 2, 1. And so you pay a little bit more in interest rate, but you get that as a step-down versus the yield maintenance. Supposing 4 or 5 years from today, the interest rates are lower, then your prepayment penalty is going to be higher, because your Fannie or Freddie is counting on you paying this 5.5% interest rate, for example, for the full term, which could be 10 years. And instead you're exiting the deal in year 4. Well, too bad. You owe me the interest for the remaining 6 years at the rate at which you got the loan, which is 5.5%. So that's why the penalty can be pretty high, to the tune of millions. And we had a deal that was on a fixed rate Fannie loan that we actually ended up selling in this year in March of 2023. And our prepay went down drastically because interest rates went up. So what was a prepay to the tune of $1.3, $1.4 million in early 2022 ended up being like in the range of $400K by the time we sold it. So it could be beneficial if your interest rates are going to go up. But if interest rates go down, then your prepay is really high. So again, that's a speculative number versus, and nobody puts it in their underwriting that I know of all the underwritings I've looked at, versus when it's a step-down prepay, you know exactly what that exit fee is.
Exactly. So we're in a scenario where, and I'm just a limited partner in this deal, but we'd assumed a mortgage that was at a 4.3% rate in, I think, late 2020. So we actually got an expanded cap rate because the seller had to have someone assume it, otherwise their prepay or their yield maintenance would have killed the deal. Fast forward 2 years, a 4.3 all-in rate's actually a pretty good deal, and it's sort of being shopped off market quietly right now, just because we need to, we don't 100% want to sell, but we're seeing if we get the right deal. But we're getting cap rate compression just because of the 4.3% interest rate, and it's very attractive to certain buyers. So sometimes it works that way too, but. In the scenarios you've seen, if someone else assumes your loan, is that prepay waived as well for the assumption?
Yeah, you don't prepay if somebody assumes the loan. The only reason they may not assume is because there's probably no more interest only left, which means your cash flow is less. So they're going to have to be paying an amortized mortgage payment, which is more. And so at the beginning, when you take over any deal, you want every penny you can to stabilize the deal. So typically that's when people don't assume loans if there's no more IO left in it. Because if you assumed a loan way back in 2020, I'm guessing today there's no more IO left in it.
Yeah, you are correct. It's there's still some cash flow, but yeah, that was the one challenge. And it wasn't a heavy value add. At least from what I've seen on the IO is really, really important when there's value. When there's a heavy value add, because you need that year or two to renovate and raise rents to the point where when the interest only runs off, you have hopefully 20-30% higher net operating income at that point.
Okay.
Let's talk a bit about taxes. You mentioned early on part of the decision to seek out this business was for tax efficiency, and I've explained this in various episodes, but it's always good to hear from a new perspective. Maybe you could to more of the beginner audience here, talk through how the depreciation works, how the paper losses work, and really what it means in the real world to someone on their tax return.
So for me, the biggest opportunity there was to be a qualified real estate professional that not everybody is, but it means that you spend at least 750 hours on real estate meaningful activities, meaning you're not just speaking to investors or putting together webinar slides, you're actually involved in asset management activities. So that's the question I asked my accountant to describe to me exactly what I had to do to qualify. And he spelled it out for me, so I knew exactly what I had to do going in, and I had a full 12 months to do it. The other thing was I did not have a full-time W-2 at that time, so I was mainly trading stocks full-time, besides being a mom, etc. in life. So I was able to qualify pretty quickly, and because my first deal was with out-of-state partners, I was doing all the asset management activities, going in person to the properties quite a bit. So it was pretty easy to, qualify for that basis. So you definitely want to speak to your accountant about your specific situation. But what it is back in the day, we also had 100% bonus depreciation. And in addition to, the accelerated depreciation. So what that ended up was a lot of deals. If let's say you invest 50K into a deal, you could have a 50K write-off. So let's say your total income for that year was 100K. You could write off 50K in that depreciation, which meant that, let's say a third of it, which is roughly 17K, you could reduce your tax burden by that much for that year. It doesn't mean you never pay taxes on it. You're kicking the can down the road. So there is the concept of depreciation recapture that comes into play when you finally sell the deal. But at that moment, for that tax year, if that's when you have a lot of, let's say, gains from stocks or other sources, that's a good year for you to look for that tax savings. And so for me, that was a big one, to be able to get the tax write-off from depreciation because I followed the rules as my accountant described it to me.
Yeah, and what's really powerful is if you're married and one spouse is a real estate professional and the other spouse has either a W-2 or just an active company where it's considered primary income. So, everything gets pooled together. I assume that's your situation. I think.
Correct.
Yeah.
That is it. So we were able to offset, first the gains from things that I had made, and then eventually to a portion of his W-2 as well. I mean, we didn't come down to zero taxes, but we definitely saved a bundle, right from the first year.
Yeah, that's amazing. Yeah, I know some people who've really maximized this. Seven-figure earners who had already had a little bit of a rental portfolio, but were able to take it to that next level. And they manage their own rental portfolio and qualify. Then many of them actually invest into real estate syndications as well, because once they have all the hours and everything is, again, this is not official tax advice, but there's an option to kind of pull together all the activities together. And once you have those hours. In many cases, syndicated investments can, pass through just depreciation against your other rental income. On a small scale, also, I do want to point out that, if you have a W-2 but you own a few rental properties, generally the passive losses that come from syndications can offset your other passive income. So if you're a W-2 but you own 3 rental properties and they're free and clear and already depreciated, you can often save some money by investing into multifamily and get a much better depreciation percentage than another single family property.
Excellent point.
Yeah, so you had a tech background, and I know you focus a lot of your content. You're amazing on LinkedIn, and certainly a follow.
Thanks,
and we we'll put your link in the show notes. But talk about your kind of core audience of investors and what how you work with them and how you can both for passive investors, and I understand you have a mastermind as well for operators too. So just talk through some of the ways you provide this great information to the community.
So most of my investors are pretty sophisticated investors who understand either financials, numbers, and are very comfortable with spreadsheets, and they love data. So I always provide content that discusses different pieces of data and, sprinkle in my journey, my career, etc., and how I found my way from tech career or from where I started as an immigrant all the way now. So it's a little bit of a, view of who I am, but at the same time, data and conclusions and to some extent, different perspectives on what's happening in the economy right now is how I am able to reach my sophisticated, intelligent audience. And that's how they feel like they already know me by the time we have a call set up with them. They usually send me DMs. Most people, as you can imagine, don't like to be pushed and sold on anything. So all of 2023 has been great because I've actually not had any deals, not had any pressure of raising capital for a deal, and etc. So this is the time to build those relationships. Typically, we have multiple phone calls. We discuss a past deal because then again, there is no pressure, but they get to see exactly my value add play, how I do them, how I find them, etc. And then that's what typically leads to then their opting in to my investor list. So I have two separate lists. One is just a newsletter kind of thing for educational content, come to my webinars, etc. But the other one is, okay, now you're giving me permission to actually be added to my database to be informed of future opportunities. And I think that's worked well for me. And they hear about me a lot from past investors too, now that I had some full cycles. So that helps a lot.
That's great. And I understand, if people are looking to be more active, you have a separate group for kind of coaching people that may want to become an operator like you are someday?
So I am not teaching people how to find their first deal or underwrite them. This is actually a small inner circle, and it's intended for people who already are into one or two deals, but want to improve their operational efficiencies. I think this year and the next couple of years is going to be the year of operational efficiencies, thorough asset management, finding those hidden pennies in the couch, especially if you have floating rate deals, etc. You just have to operate more efficiently, look more closely at the ROI of every dollar that you spend on these deals, and see, why should I spend $15K on an interior to get a $200 rent bump? Maybe I just spend $2,500 instead, do some basic make-readies, get the $50 rent bump and move on, right? So you really have to look at your payback period and ROI on every investment you do, and then look at that rent roll and start adding value to residents who are your customers in ways that they're willing to pay for. Like washer-dryer connections is super popular, but maybe not the granite countertop and platinum upgrades like stainless steel. It's like, I'm not really going to pay $100 more just because you gave me a new fridge, So think about it from the perspective of a resident. So we're going to focus completely on operations, and it's a mastermind. So different people will also have their collective inputs, and we're going to learn and grow together to, combat the rising insurance, taxes, as well as, mortgage payments in some deals.
Yeah, that's great stuff. And operations is extremely important as someone who's in 40 different deals just passively.
Yes.
We've seen the reports, and what's set apart our best operators is being able to step in when the property management is struggling. We had a group that put two of their internal people into a property, and the property manager was having a hard time hiring. And I know Dallas, the economy, I assume, is doing generally is better than the rest of the country in general too. But have you had issues, or have you seen your management companies have issues just hiring and retaining staff, just with the job market being so red hot in Dallas?
Yes, for sure. A lot of the really good people want to leave because they get offered a higher salary, but we've been able to have a stronger relationship with them. One of the things I do is frequently visit my properties. I have lunch with my on-site staff. I take donuts to them. We have maintenance appreciation day, because ultimately your on-site staff is the face of your property, and millions of dollars are on the line with a couple of people getting 50, 60, 70K kind of salaries. So you really want to make sure they are feeling appreciated and retain them. But we've had challenges. We've even had to fire property management companies in the past for not meeting metrics. So it's if I make it seem like it's easy, it's not. It's definitely a struggle, and you got to constantly stay focused. And that's why I started this group, aceoperators.com, which is going to focus on strictly on asset management and how you can just find those hidden pennies to improve that NOI while doing the right things by the resident. And don't forget who your bosses are. Your bosses are the lender, the city inspector, your residents, and then your investors. So you got to answer to 4 different bosses when you're a general partner.
That's very, very well said. So the name of the show is Alternative Investor Mastermind. We talk a lot about real estate, but I am also just curious, are you into anything else alternative? Do you have any crypto, or is there anything outside of the stocks and bonds other than real estate that you've invested in?
So I only invest in things that I fully understand, and unfortunately I haven't explored crypto enough to understand it. But what I have invested in is definitely gold and silver, and then currencies. And self-storage is the other thing. It sort of ties pretty closely with apartments. I have looked into other asset classes. Car washes are getting super popular, laundry centers, mobile home parks, of course, and RV parks. And I've got many friends invested in those assets, and of course, Airbnbs. So I'm exploring them, but I haven't studied and underwritten them well enough to start investing just yet. But it's in the list of, things to explore.
Yeah, and that's always for me. I'm very careful not to chase shiny objects, but not being an operator, we're a little bit more diverse, and certainly I've done some self-storage, mobile home parks. The most exotic thing on the real estate side is we are in an RV that also has a marina. It's a lake. It's not a it's a lake. It's a lakes in Tennessee. It's not salt water, but that was one of the more exotic things. But it's important to keep your eyes open, but not be, not lose focus. So I think that's something it's been a constant balance for me, and I try my best to balance exploring and research and development with staying focused on the core. So,
time blocking helps a lot. So I do allow creative time and free time, and sometimes I'll listen to a podcast on an alternative asset on a walk or something. But, as far as actually digging in and investing, I wait for a friend to do it, and then I talk to the friend and I get my Cliff Notes version of it. That's usually been the easiest way for me to catch up. But I've also tried land, and then it's the same rule with stocks as well. I don't invest in companies whose business model I don't understand, just because it's the latest trendy stock on some news. If I don't understand that industry, I'm not going to put money in it. Amazon and Apple and Walmart and Target, we all understand those. So those are pretty straightforward.
Gotcha. You mentioned you were just speaking last week, and I tell even passive investors that this is active passive investing, but when you're an operator, it's active investing. How many events are you going to a year to stay up to date on industry trends, and then how many properties do you think you actually look at and underwrite in a year to find maybe that 1 or 2 diamonds in the rough a year to buy?
So in terms of events, I attend more events that are local in Dallas, and several happen. So such as Old Capital Conference, Dealmaker Live, AIMNATCon. But in the summer, I travel a little bit more. And so I went to Multifamily Investor Nation Conference, which is phenomenal. I went to it last year as well. And I was invited to speak, so of course I love to go to it. It's by Dan Hanford in Charlotte. I went to Best Ever because, again, I've been a fan of Joe Fairless for a while. And his conference happened to coincide with spring break for my son. So I was able to take my son and go along. So those things help me a lot. If I'm able to include my family in some way, and it's not like an important time in their school year, like the first week of May, when things start wrapping up, that's a difficult time for me to travel. So it depends on the timing. But there's about half a dozen or so conferences that I really love to attend and keep up with my peers. In terms of underwriting deals, like I said, I'm so strong in my local market that I don't need to underwrite a whole lot of deals in terms of numbers. I already know, based on the address and zip code, if I'm even interested. The basic screening of median household income and crime, poverty levels, schools, etc. is an easy screen for me. In 5 minutes, I could decide if I'm interested or not. The second level is to where the price per door based on the class of property and the term sheet that they send me from a direct lender. So we call them the DUS lenders, who are designated underwriting lenders by Fannie and Freddie. When they give me a term sheet, I know that's going to come true. And so based on the leverage and how much we have to raise, etc., then I drive by and underwrite. So I underwrite maybe 3 or 4 properties. When maybe 100 come across my desk, I'll only deep dive into maybe 3 or 4 of them. And I like to underwrite it myself, because as I'm doing those little inputs into the spreadsheet of every number, I'm like absorbing it. When I copy from the T12 and put it into a spreadsheet, I don't want to hire a VA to do it, because now I'm learning it. I'm seeing those numbers as I type them. I'm slowly absorbing the story of this property through its T12, because numbers tell you the truth, and they tell you a great story of where the operations are. I wouldn't miss it for the world, because I'm a total numbers geek.
Yeah, that's amazing, and I'm jealous of you being in Dallas, A, because of the number of events, and B, just that knowledge. When I got into real estate, I somewhat had that knowledge in Rochester, New York. Not that there's many multifamilies or much, although I do know a couple of investors who do some syndications up there now. But yeah, being kind of learning a little bit about Puerto Rico now, although I'm not really doing much investing here, just kind of run the business from here. I have to get out there to visit at some point. I'm craving some barbecue as well.
Please do, and come to some of the events that I just mentioned to you. Those are great conferences to come to. And yeah, the Old Capital Conference, for example, is in October, and it's right before the Raise Masters annual event. So you could do 2. And the Raise Masters event is, as you know, in New Orleans. So you could come to Old Capital, attend it, fly to NOLA, and it's pretty easy to combine both together.
But yeah, that sounds great. I love going to events as well. I go to as many as I can. Sometimes I need to take a break and just kind of force myself off the road for a period of time. I ended up, I would have been in Charlotte with you as well. I had a family commitment and just was double booked. But yeah, for those, if you want to get into the space as an operator, these events are great. If you are just looking to be a passive investor too, I don't think there's any substitute for being at these live events. You get to meet great operators in various markets. And I think just as important, you get to meet other passive investors who've already done this and had success. And that, to me, that's the biggest proof of concept is, a reference of, hey, John Smith invested and made money and knows this group and has done 10 deals with them. And, in an era of being worried about, a Madoff or any other, scams or challenges, like, face to face with real people is, there's no substitute for that.
Agreed. I couldn't agree more, because when you go to these conferences, you form a peer group, and then everything that you see, on your phone in 2D from your Facebook groups and LinkedIn becomes 3D. And it's just amazing to see people who you've sort of now developed a friendship over the years just from your pure digital online connection. And those friendships get strengthened, and you form a small network. So you you do tattletale on bad operators, and you figure out who to stay away from and who to, go invest with. And that's very important. I think if all I got was one tip to avoid a bad deal, the conference pays for itself. So I definitely see a huge value in having personal connections face to face by attending these events.
100%. So let's take it back to the beginning a little bit here. You mentioned your first deal that went full cycle, and now you've had a couple full cycle deals. So you started that deal sort of riding shotgun and doing, kind of putting in some sweat equity and some money, I assume, but sweat equity. And then now, are you generally the lead? I know these are large deals, so very rarely is there only one person involved on the general partner side. How do you, and are you with some of the same people in that first deal? Is that team sort of kind of just ridden together and grown together?
I've done another deal with that same group, but since they're quite a bit ahead of me and they're established, what happens is, their name is what gets out, and now I sort of need to branch out for myself. So I still have one active deal with them, which is great. I love that partnership. But I've got another set of partners with whom now we've done 3 deals, and I think we're ready to sort of commit, if you will, having dated for a little while. So we're going to go together and do more deals. And so we all 3 of us take an equal share, an equal part in everything. We call each other our leads. And so when my partner underwrites a deal, I also in parallel independently underwrite the deal, because it's great that we both can then compare and see where the value add potential is, etc. We do have one partner, the third partner, who's extremely strong in, like, a very handy person, due diligence. He could pretty much fix anything. He could walk around a property and tell you how much it's going to cost you to repair, like, the cracks in the foundation or the parking lot, etc. So it's very important. So he's like the lead on the construction side. And then, I get out on social media a lot. So definitely we all do our share in raising capital. But I would say I probably take a little bit more of a lead on that. We typically have anywhere from 3 to 5 people in our general partnership team, but our core team is 3 of us. And, one deal we partnered, a couple of deals we partnered with people living in Dubai, the Dubai couple, for example, or people living in the West Coast. And they love to mainly be the capital raisers and also do the investor relations, the taxes, and maybe coordinate cost seg kind of stuff that can be done online and remotely without having to be in person at the property. So each team member has a role, and that really helps bring it together and reduce the workload on us as well.
Yeah, that's great. This multifamily, more than anything, is definitely a team sport, just due to the size of the deal and the requirements. I mean, there's actually, I'll let you say. Maybe you could just walk through what are the financial requirements to get a Fannie or a Freddie loan, as far as kind of net worth and liquidity, as far as percentages of the loan.
So the biggest thing is that the people signing the loan combined have to have a net worth and liquidity. The net worth has to be more than the amount of the loan. So if you're getting a $20 million loan, then all the people signing the loan have to be, having a net worth of over $20 million. And in terms of liquidity, I think they want us to have at least 10% liquid among all of us combined who are signing the loan. And so sometimes we get people with that high net worth and liquidity. We went after a large deal last year that was $30 million. And, me and my two partners combined didn't have the net worth for it. So we had to get somebody with a high net worth, and he was very happy to sign the loan for us and stay out of doing the management side of things. And he invested a good amount of money. He was a former investor in that first deal where we tripled his money. So he's very happy. So he's like, oh, I'm going to invest a lot more for you. And he actually wrote a 7-figure check, which was incredible. So that helped us a lot with the raising for that deal. So yeah, it's important. And then the other thing is you want a history of having done that loan before. So if it's Fannie, you want at least somebody who's got what I call the Fannie card, which means they have at least a year or so of doing a Fannie deal, ideally a full cycle. So I have signed on loans before I became a general partner, just to have a Fannie card and a Freddie card, if you will, to have that experience as a key principal from signing those loans.
Yeah, that's great. I'm actually contemplating that in the future for myself as well. It's very powerful. And to be clear, so a certain. If there's a larger loan and you have someone who maybe has a few $1 million in a brokerage account, if they're willing to sign on the loan and be part of the team, and maybe they have some responsibility, minimal responsibility, they're not signing up for some 40-hour-a-week job, and someone with a high net worth in some cases could become part of the partnership just by showing the liquidity. And from my experience, always the liquidity is the toughest one. Often operators have the net worth, but when you're full-time in real estate, you're always tying your money up into the next deal or deposits on a future deal. And it seems like most real estate investors don't want to keep that much money liquid because you want to put it to work.
Yeah, unless they also invest in the stock market or other assets that are more liquid. Yeah.
Yeah, so that's powerful. What I loved about the space when I was getting in is just knowing, people. When I talk to people that are hesitant to get into partnerships or they've had a bad experience, it's usually some small deal where you invested with your brother-in-law and you bought a single-family house and it goes sideways. Sure. But I find that these large deals, the barrier to entry is high enough, and the quality and of both experience and net worth required. You don't just jump in and do a deal. So if you're investing in a syndication on a $20 million deal with a team of experienced principals, anything could go wrong anywhere. But I think the likelihood and the risk of something going sideways is a lot less in these types of deals than going in on a single family house or a 2-family house somewhere with inexperienced people.
Yeah, agreed. It's really good to be in a world where everybody sort of plays by the same rules and we all understand syndications and the need to report to investors. And the biggest thing I would say is get to know your partners well. Date before you marry. Even though everybody is great the first few times that you meet them, but until you know them and what they would do in a tough situation, you never know. So have the tough conversations. For example, one of the things we talked about is, let's just say for some reason, some calamity happens and we've got to sink some money into the deal because maybe 20 units got flooded and we've got to immediately do the repairs. Would you be willing to put money and how much? Those are the kind of conversations we have as partners. So we know exactly how much liquidity we're going to keep so that we never make a capital call. That's a big important thing for us as partners. So do you agree on those values, or are you going to say, well, things happened, it was beyond my control, let me go make a capital call, right? Depends on that attitude. So are you more transactional, or are you more building relationships so you have repeat investors? I have investors who invested in like 5 deals with me, right? Those are the kind that I want. And those are the kind that I want to give me referrals. Rather than, oh, today I tricked you into wiring money for me. Bye. I'm not going to talk to you again for another 5 years or until I need money again. You want to avoid those relationships. So you really want to understand if your values and your partner's values really align, so that together you guys can agree on the way to proceed when bad things happen. Because when it's good times, it's easy. Anybody can be a friend. Anybody can be a partner when the times are good. For the next 2 to 3 years, it's about operational efficiencies. It's about scrutiny. It's about how much work are you willing to do, roll up your sleeves and do in terms of sweat equity as well as putting money into the deal.
Yeah, very, very well said. And I've seen that on my end too. So we've had operators that flew staff to a property because the property manager was understaffed. We had one put nearly 7 figures of his own money just because the construction draws from the bank, from the bridge lender, was slow. So to avoid a work stoppage, they just lent money in with their own money until the draws came together, just to make sure the renovations kept on top of it. So, the core values that you're saying right there are super important. I know you live them. So,
thank you.
So how does anyone get a hold of you? What are the best, your website, social media, etc.?
If they're a limited partner, they can find me on acepassive.com. If they are a general partner wanting to become better operator, interested in my inner circle, aceoperators.com. Certainly you can find me on LinkedIn, Facebook, and of course through our host, Jack.
Great. And we'll put all the information in the show notes as well. This was great. It was a great chat. I really appreciate your time and coming on the episode. Dropped a lot of knowledge to the audience here. So, and thanks again. And hopefully we can do it again sometime.
Thank you very much. It was an honor to be here.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.